Then, as you mentioned earlier, it would be good to look for companies whose stock prices can double or triple even during the maturity stage. Let's move on to the maturity stage.
So does that mean there are no big winners? That's not true. There are. There are, and it's just that their stock prices rise slowly. Later on, you realize, when did this company go up so much? Those are usually the ones in the maturity stage. Growth stage companies rise rapidly, catching attention. Mature companies seem dull, but one day you realize they've grown significantly. Mature companies often exhibit this subtle, steady growth. So, for more conservative investors, it's better to invest in stocks of mature companies. But if you can handle growth stocks, then growth stocks are good, and even some introduction stage stocks can be okay. Actually, I think it's best to decide where you can and can't invest based on the type of investor you are, your investment tendencies, your age, and your financial capacity. I've summarized the main data checkpoints for mature companies into about 5 points. When a company reaches this stage, its sales and earnings per share growth rates are usually around this level, about 15 to 20% per year on average. Even if they don't increase further, they should at least be maintained. If these numbers continue falling into single digits, the company will move from maturity to decline. Therefore, maintaining sales and earnings per share growth rates at 15-20% is crucial going forward. Secondly, if the sales growth rate drops to around 10%, you should consider that a warning sign. So at this point, just like when we first discovered an early growth stock with our instincts, you should be asking yourself if it's time to let go of this stock. The main point you need to focus on now is that when the growth rate drops to around 10%, you shouldn't hold on to too much attachment. It's much better to just let it go. At this stage, the crucial data to examine is whether mergers and acquisitions are occurring. This is essential for mature companies to achieve renewed growth. Next, how are the trends in R&D expenses and tangible asset investments? So whether the company will invest in these and achieve regrowth again or not is extremely important. Companies that keep reducing and stopping their R&D and tangible asset investments are basically following a strategy to simply maximize their current profits. Then, in the long term, you have to see it as the engine gradually shutting down.
That's what it is.
It's really important that this part increases, but when it does, the company that's making a profit should be impacting the company's value, right? We're in R&D and have invested heavily. Okay? For example, let's say there's a student who has to take an exam. To help this student, you get them a tutor, hire the best instructor, buy them workbooks, and invest a lot of money. In Korea, high school students are ranked from level 1 to 9, and this student is around level 7 when it comes to grades.
That's the result.
So the research and development expenses didn't yield good results, meaning the amount of R&D spending isn't what's important.
So the first
thing is that you need to be making investments, and the second is that you have to see if those investments are actually producing results.
That's what it is. So
today I will reveal and introduce the indicators used to evaluate these results. So actually, these indicators aren't really something to be covered at the beginning of the course. In my opinion, this is something that should be covered around the middle or advanced level of the course.
I think, but right now,
I'm uncertain if this suits the course's beginner level. I feel like I've gotten too deep into this, but I still think it's better to cover it before moving on. The first one is called the fixed asset turnover ratio, which is an indicator we all know, but we usually just know it vaguely. Fixed asset turnover, sales divided by fixed assets. But what does this actually show about a company? It actually represents something very important. Fixed assets are the equipment that allows a company to produce more goods.
It's an investment, like a factory.
You invest in things like land, machinery, and servers, right? Why do you make those investments? By selling more products and making money. When I talk about this, you remember those square boxes I drew in the first session, right? The ones that moved back and forth. If those come to mind even vaguely, it means you've completed all of Mijuchu. But if you don't know what I'm talking about, then you probably need to start listening again from week 1. I mentioned that using these tangible assets means assets are meant to be connected to sales, and these tangible assets are things like land, buildings, and machinery. The company keeps increasing its servers, but this is for selling products, and to sell more, it needs to be connected to sales revenue. So, whether these tangible assets are connected to sales revenue is shown by the tangible asset turnover ratio. So, looking at the tangible asset turnover ratio is a very important indicator to see whether the company's facility investments are actually being sold as products and connected to sales revenue. So, by looking at the trend of how that indicator moves compared to the past, you can see whether the company is selling well or not.
You can.
I brought this case data, so I'll talk about it later at the venue. The R&D expense turnover rate is the second one, which rarely appears in financial indicators. I just gave it this name myself. I named it because it does appear a bit in general papers and there are some places that use it, but it's not really covered much in standard financial formulas. But the reason I think it's important is that tangible asset turnover mainly applies to manufacturing industries. Service industries don't really have tangible assets, but in service industries, the equivalent of tangible assets is people. It's manpower, and the cost that goes into that manpower is research and development. So when you invest people in R&D, the question is how much that translates into sales. This is similar to the concept of tangible asset turnover. So for manufacturing, you look at tangible asset turnover, and for service industries, you create and use the concept of R&D expense turnover. So if you can combine these indicators yourself to see certain aspects of a company, then from a financial perspective, when analyzing a company, you end up looking at a huge number of indicators. That's why these indicators are very important for judging whether a company in its peak season is losing momentum or starting to grow again. Secondly, if this turnover rate goes up, it's an indicator that shows the investments made are being successfully converted into products and are selling well. So, for companies in their peak season, if you go into the value stock section in our investment recipe menu, you'll see that they're currently on sale like this. Most of these have high scores and are simply undervalued.
There's stocks like that. So
If you look here, you'll see a list of these companies. In the case of Segil, it went up so much that it's now considered overvalued. You've probably heard a lot about Food Holdings, New Holdings, and Elf Beauty, right? Elf Beauty was a cosmetics brand that MGs really liked, so its stock price skyrocketed, then it almost halved and was forgotten by the market, but now it's slowly rising again.
it's gone up a lot again. So
Does that mean this company has a really high growth rate? Not really. That's because the valuations were excessively low compared to this growth rate. So as they return to normal, that's where the returns come from. You can see things like this, and I brought some examples of stocks as case studies. Among these five, actually, Enbidia is a company that's both in its maturity stage and its growth stage. In my opinion, it's almost unique. Among the United States listed companies, if you reach this level, you usually have to be 100% in the maturity stage, and your growth rate should drop to the 20% range. But Enbidia is a company that has all the indicators of maturity, yet its growth engine still hasn't stopped. I brought operating profit instead of net profit, along with revenue, R&D expenses, and tangible assets. That's because operating profit is the profit generated from the company's core products or services, while net profit reflects non-operating factors. So to focus on the essence, I chose to use operating profit. So, for this indicator, you can just copy it straight from the financial statements we saw earlier on our website. Just drag and copy it, then paste it into Excel or a spreadsheet, and it fits right in. That's what I did. So far, I've focused on sales, R&D expenses, and tangible assets due to the numerous items. To calculate tangible asset turnover, divide sales by tangible assets. For R&D expense ratio, divide sales by R&D expenses. Only these two calculations are needed. After that, if you just drag it down in Excel, all the calculations will come out automatically. It actually takes less than a minute to do the calculations. So what we need to look at here is the change in turnover rate. The fixed asset turnover decreases from 10, 8, 13 to 3 and continues to drop. This indicates that the company's fixed assets nearly double each year by 50 to 70%. However, increasing fixed assets does not instantly translate to higher sales in the same year. Production starts only after facility investment is finished and the factory begins operating, causing a time lag. During this lag, fixed asset turnover decreases due to a lack of sales generation. Once the time lag ends, turnover should recover. If it continues to drop without recovery, it's unusual. The growth engine is shutting down.
the company fixed assets.
The company is investing in and creating products that don't sell well. So that's the right perspective. But if you look at Envidia, you'll see that the number dropped to 5 or 6 and then decreased like this because they kept increasing their fixed asset investments at a very rapid pace. But as of January 2024, even though their fixed assets increased, the turnover rate jumped by almost twice as much. This kind of case hardly ever happens. I showed it on an annual basis, but you can also calculate this on a quarterly basis. If you do it quarterly, it'll be much easier to track. Next, if you look at the most recent data, it has gone up to 16.1. What this means is that this company has been very successful in creating products that sell well by connecting tangible assets to sales, and this financial indicator shows that the company's management activities are going well and the products are selling well. The growth potential of these companies is still ongoing, as evidenced by the R&D expense turnover rate, the second indicator. It's 3.7, 7.0, and 10.1. So by putting people in and creating good products
Developing and producing them.
and selling them, we can interpret through this indicator whether we are actually connecting to sales and creating products that meet the needs of the market. Then on the other hand, let's look for the ones that gave us bad signals. It's not that I particularly dislike this company. I'm just giving you an example. If you compare semiconductor companies Way, Micron Technology, and Intel, for example, Intel stands out. If you look at the fixed asset turnover ratio in 2015, it's 1.7, 1.6, 1.5, 1.4, 1.3, 1.4. Up until then, it was being maintained, so it was okay. Because for the fixed asset turnover ratio to be maintained, the sales growth rate has to match the increase in fixed assets. That's how you get the same value. If the fixed asset turnover ratio is maintained, sales are increasing by at least the amount invested in fixed assets. A stagnant turnover ratio doesn't indicate halted company growth. Only a dropping turnover ratio signifies stopped growth. But if the turnover ratio is increasing, it means that the growth rate in sales is higher than the amount invested per unit of fixed asset. So if you look at this company, when did the engine start to stall? Of course, it happened little by little, but it wasn't a big problem. Because it's 1.5, 1.4, 1.3, 1.4, and so on. But if you look at it now, 2022 is the problem. It's dropping like 1.2, 0.8, 0.6, and so on. Does this suggest they failed to invest sufficiently in tangible assets during that period, despite tangible assets consistently rising? So,
Money is also for private tutoring.
despite hiring tutors, enrolling him in online classes, and buying workbooks, his grades continued to decline.
It's that kind of concept.
That's what it is. The R&D turnover rate comes out the same way. In these companies, their growth engine had already started shutting down 2 or 3 years ago. The reason for this is that despite investing in tangible assets and R&D, they weren't able to create products that really succeeded in the market. That's the right way to interpret it. Take Micron Technology, for example. Semiconductor companies are typical cyclical businesses, so they experience a lot of fluctuations. In the case of this company, their performance fluctuates greatly, with significant swings between profit and loss. If you look at Micron Technology, you'll see that their revenue surges dramatically and then drops sharply again. These kinds of changes happen. This pattern is a typical example of a cyclical company. Most companies that produce semiconductors generally show this kind of trend. We closely monitor the fixed asset turnover ratio, which is 1.3, 0.8, 0.7, 0.8, 0.7, and 0.4 over the given period. This point marks the beginning of the crisis. As of August 31, 2023, it's been cut in half. This means fixed asset investment continued until 2022, but nearly stopped in 2023. The decrease is likely due to individual company circumstances. But when the sales revenue was cut in half at this time, that's when the real problem started. Next, if you look at the period from September 1, 2013 to the end of August 2014, you can see that the fixed asset turnover is recovering like this. 0.4, 0.7, and then you can also see that the R&D expense turnover is recovering like this again. So this one is still showing signs of a turnaround and is starting to come back to life. So we can see that at least based on the current indicators, it's moving a bit differently from Intel. So if we try to pose a question here, back when I used to give a lot of lectures, I used to give out a lot of quizzes. In offline classes, I would give a quiz and have people solve it. So, the quiz I gave was about how much revenue this company could achieve in the future with this level of investment in tangible assets. Assuming there's no analyst consensus, would you like to try estimating it? I gave this quiz as a common sense question. This part is about the fixed asset turnover ratio. At its peak, it's up to 1.3, and usually it's 0.8. What that means is if things go well, the tangible assets are 43,165. If it reaches about one time in a boom, Micron Technology's sales could go up to around $43 billion.
That's right, because
During a boom, they maximize the value of their tangible assets, which could reach up to one time their worth. Then, if it's about 0.8 times, that's a bit higher than this. So around 300, maybe $340 million, something like that. So if you look here, they're also rapidly increasing their tangible assets recently. As tangible assets increase, they need to maintain the turnover rate for this part. When the industry originally recovers, in the case of Macuron Technology, it's possible that their sales could rise a bit more than now and even reach an all-time high.
These kinds of movements
Are happening. Looking at tangible assets in combination with other indicators, such as sales revenue, provides insight into a company's performance. Tangible assets represent investments, while sales revenue shows the outcome of those investments. When you mix and create indicators that match results in business management, you can see things in the financial statements that allow you to estimate management activities. Microlin technology. Then, since I'm curious too, let me click on it just once. There should be a consensus on the expected performance. Let me just take a look at the report. Micron Technology is showing a buy signal right now. It did, and if you look at the scores like this, if you click here, the overall score has gone up.
and then
The monopoly score is a bit.
has increased and financial constraints.
The score has improved. Profitability is now increasing very rapidly. You can see here that the points that were at 0 and in the red a year ago, like 60 points and 65 points, are continuously improving. If you look at our projected timeline at the bottom, this year is $35.4 billion and next year is $44.7 billion. As I mentioned earlier,
to the boom,
if there's a boom, it could go up to that level, and those numbers are almost being reached. So from that point on, if tangible assets don't increase any further, it won't be easy to keep growing at that rate. There needs to be more investment in tangible assets. But if the semiconductor industry goes into a slump, all these tangible assets will become a burden. And that's the kind of pattern we're likely to see. So if you look at those movements and judge the financial information I showed you earlier, I think it will help you evaluate companies that are in this mature stage. I've explained everything up to the maturity stage, and I hope this has been helpful to you.
Of course, like as I mentioned earlier, you shouldn't think of this as being late to the game. This is proper backtesting, and as we keep doing backtesting, we'll eventually have opportunities to be a bit more courageous and make bold bets for good profits in similar situations in the future. There are two typical examples of backtesting that come to my mind right now, and they happened not too long ago. In 2022, Meta's stock price dropped by 75%, and at that time, Netflix also dropped by more than 70%. So if we had studied enough back then, we could have looked at these specific numbers and diagnosed whether the current price was truly undervalued or if the company was actually going bankrupt. If we had been really confident through various studies at that time, we could have made significant gains by investing in stocks like Meta or Netflix. I believe such opportunities will keep arising. So personally, I hope that next time a similar opportunity comes, I won't miss it.
We will also keep adding things like trends and charts for tangible asset turnover on the site so that you won't miss those parts in the system and can easily see them.
What I think
One of my life goals is to implement all the ideas and things I've been thinking about into this choice DAX system.
that's one of them. And in terms of business,
So my goal is to finish all of that and then retire. Yes.
you still have plenty of time. And since you're still young, I think it would be great if you achieve all those goals before you retire. Today, we looked at three typical examples of stocks: the introduction stage, the growth stage, and the maturity stage. There's a message I'd personally like to wrap up with. Earlier, the chief executive officer said something like this. He said that he hopes the introduction phase only takes about 10% of the total funds, and I completely agree with that message. There are some investors who only invest during the introduction phase. Some people like me usually invest mainly in growth stocks, while others prefer to invest more safely in mature companies. If you had 10 stocks of each of these different types of stocks. Some people invest in only 10 introductory stocks, 10 growth stocks, or 10 mature stocks. If their investment returns are similar, in my opinion, the person who invested in mature stocks did the best, because there was less risk. So I think we need to evaluate the return considering the risk. So even if you get the same results, if you invested in a stock with huge risk and got the same results, I wouldn't consider that a successful investment. So I think the performance of someone who picked one or two stocks and got a 50% return should be evaluated differently from someone who invested in 20 stocks and got a 50% return. So for those of you watching this broadcast, I hope you have a healthy mindset and invest in growth stocks. The early stages are fun, and there's the excitement of betting and also the fun of watching growth. I think these are stocks worth betting on. And to increase stability a bit, it would be good to have a lot of stocks that are in the maturity stage as well.
I think that would be good as well.
So depending on your own investment strategy, I hope you can diversify your investments and create an investment journey that is both safe and profitable. I feel like I've received a lot of help today as well. So over the course of 2 weeks, we've studied using the company's growth cycle, and I really feel like I've learned a lot during these past 2 weeks. We've also tried backtesting, and I think if a similar situation comes up in the future, we'll be able to make more successful investment decisions. I'm already looking forward to seeing what topic you'll bring to the next American Stock Elementary School.
Next time, I think it'll be the last part of the income statement. Yeah. I'll explain how to judge situations where operating profit and net profit diverge, like when operating profit is positive but net profit is negative, or vice versa, and how to determine whether these situations are ongoing or not.
That sounds interesting too. I hope this week flies by so next week arrives quickly. You worked hard late into the night again today, and I'm sorry for coming in late again. Not at all. Then, please stay healthy until we meet next week, and I hope you have a happy weekend. You too, Chief Executive Officer. Have a good time. Thank you.